Kate, reason number one, what is it?
The first reason, which has occurred to me on many occasions and still continues to occur to me to this day, is that you don't have any idea why you purchased the shares in a particular company to begin with. And I think this happens a lot to beginner investors when they're introduced to a company through social media, different forums, maybe a Facebook group. Maybe you even heard about a company on a podcast. I mean, there's lots of investor and finance podcasts aside from ours, and we do mention names of companies. Maybe your Uber driver mentioned it or your father told you about it. And you end up with investments in your portfolio as you go along that you don't really know that much about. And even like Stake, when they were giving their free share, if you signed up with a referral link, one of our friends was telling us that they ended up with quite a few random US companies in their portfolio that they didn't know that much about. And so I think it's quite interesting over time as you're figuring out how to invest and how you want to do it. Often you can end up with some companies in your portfolio that you probably should know a little bit more about if you're going to keep holding them over a long period. And I think it's a challenge having too many companies in your portfolio you don't know anything about, because when the company starts having a challenging time, maybe the share price falls, and if you don't know anything about it, you might not really understand what's going on, and you don't know whether you should hold it or whether you should sell it. And you might not have the conviction to hold it through a challenging period of time. Whereas if you had done your research and you could look at what's going on, do I understand the broader picture? Am I still happy to sell? You'd have a bit more context there.
I think a really good example here would hit home. So maybe if you can share an example with us of how this can happen.
Yeah, absolutely. And this is an example we see time and time again. Most of us did it at one point, okay. Our family, friends, people we work with. So let's say someone's just getting started. We'll call him Patrick. He opened a CommSec account and then he just started to buy some different companies that he saw mentioned in various hot copper forums. Maybe he saw the company listed on Reddit or Twitter, and he just sort of added to his portfolio that way. And he wasn't really concerned about researching because he was busy and he just wanted to have a go, which is completely cool. And it's a way a lot of us get started. But a few years later, Patrick's figured out how he wants to invest for the long term. He's done his research, listened to some podcasts, maybe he read a few books, and he's had a look at these companies and he realizes a lot of them don't align with his new investment approach. And so he doesn't want to waste time researching them all. So he decides to sell them because he wants to focus on his new portfolio strategy going forwards. And sometimes, like this happened to me like years ago when I was just getting started. I had no idea what I was doing. I was just sort of having a bit of fun. And once I figured out what I wanted to do, I kind of wanted to clean the slate completely. I was only playing with a small amount of money, so there was really no tax issues to be aware of. And I just had to pay the cost of brokerage just to start afresh, start from zero again in the brokerage account, which helped.
So that's a good point you bring up there about tax. Just so you know, if you sell it at a gain, so meaning that you buy it $10 and you sell it $15, you will be taxed on that as a capital gain. If you hold the investment for more than 12 months, you typically will pay less capital gains tax. That's a question we get a lot. It's different to when you have an ETF. You also pay capital gains tax there, but you can also pay tax, when you get that annual member statement. So it's a little bit different, but just keep that in mind. And this is one of the reasons why we say, trading, which is that kind of like day-to-day, week-to-week type mentality, can actually cost you a lot more than you realize. Not only are you paying brokerage costs and you're probably getting subpar returns, unless you really know what you're doing, you're also going to pay more tax. There's a lot of friction there. Yes, that's a really good example. Patrick sounds like quite the hot copper user and getting
He's
started.
Reformed.
He has reformed.
He still looks at hot copper from time to time just because it interests him, but he doesn't spend all day on it anymore. And he's set up his strategy and he's pretty happy going forwards now.
Yeah, that's really good for Patrick. And people go through a lot of these.
Good job, Patrick.
People go through a lot of these cycles and waves. I've had this in my life too. Like when I first started, I started buying NAB and Telstra and all that sort of stuff. And then I thought, geez, I'm really good. And then I'll go and buy options and warrants and all these exotic things that finance people do. And that was a horrible decision. And I realized that I just had to completely reset. There's actually something that we've talked about before called the humility curve, which is where you start off very simple. You kind of get this rush of blood, particularly for men. This is what happens. You think you're really good at this, so you get more complex with your trading. and you're more complex with your investing. You might even end up dabbling in something like CFDs, which we've talked about before, are very dangerous. And then you come back down. And that's on that way back down the complexity. You become more humble and you keep it simple, and you're going to do some selling on that way back down. And ultimately, this is reason number one, is you really don't know why you first purchased shares to begin with. So I'm going to explain to you in just a minute how you can solve that problem.